All right, so welcome to this week's conversation. We've got Steve Prendeville from Forte Asset Solutions. He's all about business valuations, and he's kindly going to have a chat with us about what's going on and how advisors can look to maximize the profitability and the saleability of their business and the opportunities that are out there. G'day, Steve. How's it going?
Yeah, good, Rob. Delighted to be here with you.
Yeah, no, mate, thanks for making the time. I know you're locked down there in Melbourne, so, you've got a fair bit on at the moment, so I appreciate you making the time. What are you seeing in the market at the moment with guys that are, in terms of activity? And I caught one of your presentations the other day and you sort of touched on the fact that, a lot of people have got this misconception that, values are going down and what have you. What's actually happening on the ground out there?
Yeah, sure. The market did come back last year, and that was in the backdrop of AMP moving their bowler from 4 times to 2.5. Most of the market was trading about 3, but because of that, it came back to about 2.5 times on recurring revenue. The perception is that with all of the advisors that have exited in 2019, but around about 5,000, and this year to date it's around about, I think, 1,700 to June 30. And so the perception is that everyone would have sold as they went through, and therefore dragged markets down even further. But if you have a look at those numbers of exits, the vast majority really in 3 different camps. The first being bank salaried advisors. So their departure, there was no asset sale. The second part has been accountants that no longer are able to operate under exemptions. And there are also no sales that have come from that either. And the other one is that mainly the institutions, but some other dealer groups have deemed that businesses less than 400,000 were not profitable from a dealer perspective, and therefore some have been unable to find homes. And so there has been sales, or that they've given the business, or they just walked away from the business. A lot of those were actually sub 100,000 who were really using the revenue stream, which is predominantly grandfathered revenue, as almost like an annuity stream. So what the market hasn't seen is this flood of businesses coming to market. I think it's a bit like the property market. If you think that you're selling into a depressed market and you don't have to sell, you don't. And so I've been selling and valuing businesses for 17 years. This is the greatest imbalance I've seen on demand, which is excessive, and supply, which is at its lowest level.
Right. Well, that's interesting. So there's people out there that still want businesses.
Oh, more than ever. And that's for a number of reasons as well. The first is the cost of businesses going up. We're seeing PI increase on average somewhere around 20 to 30%. We're seeing dealer fees increase on average 25%. That's this year, and they'll go up even further. You've got the additional compliance overlay. You've got asset fees. You've got education costs that are coming in. And so the only way that you can continue to maintain profitability is, if you're not able to do it by organic growth, it's inorganic. And at the same time, we've got interest rates at its lowest levels ever. So we've got cheap finance out there, somewhere around about 5% interest rate on a cash flow brokered transaction, obviously interest deductible. We've got significant amount of capital that's in the marketplace as well. And so this need for size and synergy benefits has never been greater. And so that's what's fueling the demand.
Yeah, so people trying to get scale.
Yeah.
Have you seen you mentioned there the interest rates being at 5%, that sort of the level. Have you seen any withdrawal by the big banks in this space?
No withdrawal. LVR is still around 60-40. there's a lot more caution though. And it used to be that you'd catch up with your banker once a year and have a cup of coffee and talk about the business. Now you're doing monthly reports. So there's a lot more due diligence. The deal flow is actually, it's probably longer as the banks make the decision. So there's no retraction. It's just more caution. There's actually some new entrants that have come in that are funding at the smaller end of the marketplace. The vast majority of the banks, the leader at the moment is Macquarie, used to be NAB, and Macquarie are more in the 1 million plus purchase price. And so there's a niche which has been created for the small books. And so new financiers have actually entered in there. But yeah, no, it's still there. The other part is that as an industry, we're actually deemed to be recession proof. Going off our last recession, it's actually a period of growth as more people require advice, as there's been unlocking of superannuation. And also, you know, we're an investment market that's really hard to do it yourself, particularly if you're looking for, you know, yield with safety. And so it's never been harder.
You've got some insight to yield for safety?
None.
Right, okay, right. No, well, if mate, if you have, you could bottle that and sell it. That's for sure.
Yeah.
Absolutely. So you mentioned a couple of things. You mentioned like obviously the increase in compliance costs, increase in licensee fees, increase in PI. I mean, all those things are obviously going the wrong way. We've got a lot of cost pressure, which is, I guess, come into play over the last, to be fair, the last 5 years, and the Royal Commission has probably accentuated that. So we've got sort of, I guess, people sort of wanting to pay less. What are you seeing in regards to how is that impacting upon the profitability of firms out there in the financial advisory space?
Yeah. I'm actually seeing growth of profitability, and the reason for that is that since the passing down on the Hayne Report, 4th of February 2019, people have been re-engineering their business. And so that's particularly around annual renewals, and also the moving to fixed fees. And when you do those, just those two incentives alone, you're really coming down to value proposition, and you're looking at your tech stack. So you start to have a look at, okay, well, what level of service do we want to deliver? How do we get there? That normally, and this is why we're seeing such huge increase in the third generation managed accounts. Net Wealth's been the greatest beneficiary, but so's Hub, so's actually the whole industry, as people moving particularly from the oligopoly of the banks, the big six, AMP, IWF, they're looking for new generation platforms. And so that's their starting point. When you start with there, then you have to look at your whole tech stack and your service delivery. And this is, you know, we started off with a sort of a dark sort of assessment of the industry with rising costs. But what should be talked about is actually we're building better businesses and more profitable businesses with the adoption of technology. This adoption of technology has been dramatically increased in the last 4 or 6 months. And like we're doing now with, you know, video communication, the level of communication that advisors are being providing to their clients is unprecedented. And it's also on point. It's individual like this is, or it's collective with podcasts, video messages. And we've seen businesses that potentially weren't before tech able have moved really quickly to cloud-based technology, so people can work from their home offices and the like. And so the adoption of technology has never been greater. Now, one thing great about Australians is the ability to adapt and adopt really quickly. And so I was reading a report a month or two ago saying in the last 5 years, the adoption of technology is equivalent to 3 to 5 years. and it's come on really quickly. So when you're having a look at when people are re-engineering their businesses, each time that I've seen it anyway, when you move to fixed fees, you've moved to potentially an MDA, so you're increasing your back office, it's increasing profitability, but also increasing client value proposition.
Yeah.
So any cost savings in the value chain, and at the moment the value chain is substantially under pressure when we have a look at it traditionally on funds management. They're being active managers are being challenged by index fees. So even active managers, the fees are coming down there. Administration, we've seen some of the old guard reducing their fees as well, trying to match the new gen. And I think that that's going to continue. We're seeing dealer fees coming up because that's the removal of grandfathered revenue, subsidised revenue. But their value proposition is also increasing as well. And what this is enabling is the advice fee is relatively static. So add it all up across the value chain and costs are coming down for the client and services are improving. So we never achieved that from FOFA. There was no beneficiaries from a consumer perspective. I think they will be now and going forward.
Yeah. Okay. Well, that's interesting. So, obviously, a lot of focus on efficiencies, profitability. When people are buying businesses now, as someone that's been in the game for a while, it was always done on the 3 times revenue and that sort of stuff. Has there been any change over the last few years on how people go about valuing businesses and businesses that they want to actually add?
Yeah, so I made the comment earlier that we saw prices fall last year from 3 times to 2.5. But, and thanks for the question, because the reality is that recurring revenue is now a secondary methodology rather than the primary. It's around profitability, it's EBIT, and that hasn't moved. Profitable businesses are being rewarded for that, and it's about 6 times EBIT, adjusted EBIT. And I'm selling at higher than that. That's for exceptional businesses, and smaller than that, depending upon what the risk profile to profit might be. Buyers start off their assessment from a risk base, sort of starting from thinking about it worse. Is there any exposure to fee for no service? Is there any grandfathered revenue? Is there any compliance issues? And also the one now is there any risk on annual renewals? So they're looking at what the strength of the relationship, what has the service been to date? Are they active clients or inactive or somewhere in the middle of the two? So they're starting from a risk assessment basis. Then they come around and going, okay, well, how can the business, be improved, or does it fit our model? Do we have a solution on it? Can we get leverage from asset management? And a lot of the buyers in the marketplace have their own asset management capacity, even if it's outsourced often. But now that they've got an active philosophy around it, they're selecting the underlying platform, they're selecting the managers, and they can rightfully take a part of that value chain. So the more fun that they can bring on leads to greater profitability. But they want to firstly understand the client base, make sure there's an alignment of business models between theirs and the target, understand what investment philosophy is there, what service level there is, and also then what does the principal seek, what level of retention and the like. So.
Okay, so some other things being equal, I mean, obviously good compliance is going to be more highly valued than bad compliance.
No, it's essential. If there's bad compliance, no one wants to buy your problems.
Right.
So compliance and good compliance, it needs to be good compliance. And any fear factor, people will move on. And so as business owners, the focus should be compliance. It's the one thing that can blow you up and destroy value.
Would it be fair to say that people are actually looking, Steve, now at not just viewing good compliance as, I've had no compliance issues, to you actually need to be able to demonstrate how you've had good compliance?
Yeah, there needs to be a annual renewal and relatively recent because we've had so many changes in a short period of time. So if your last review was 3 years ago, you need to come in because there's been so many changes. And it's just good governance because it is the weak spot. It's really easy if you don't know that something's sitting there but largely it's going to be around, about the relationship with the client.
Yeah. So on that, you mentioned like engagement with technology and other aspects. So is that something that buyers are actually physically looking for now?
Yeah. So
what's your history?
Yeah, in my information memorandums now, we record how we've gone through the COVID period. So we've got a new section, which is purely how we dealt with COVID. What exposure to the client base are SMEs, how many have sought JobKeeper, how many have taken advantage of superannuation drawdown, if so, how much from. Then we've looked around and go, okay, what service has been delivered in this period of time? How many clients have been one-to-one? How many have received collective? What's the overall response been? And every time I've asked this question, the response has been overwhelmingly positive with regards to client level of engagement. We're getting organic growth. We're getting referrals now because of the service that we've done as an industry on whole to our client base. And then they're talking about the service level to family and friends. And so we're actually seeing green shoots already. So we're looking at what service is being delivered. Then we're looking at, okay, well, how did your staff deal with relocation to the home office? What new technology have you had to embrace? What changes has there been to profit in this period of time? So given that we've got nearly, I think it's around 70% of the industry has already moved to fixed fees, they haven't been exposed to market gyrations. But what has happened is that there's been reductions in rent already. If it's not already, it's going to happen. There's been cost savings in one case of staff. They were just because of the uplift factor and the level of engagement by most of the staff members that was deemed to be, we've got someone extra here that we don't need. And so this has been a period of, I suppose, great reflection as to what are we delivering, how much, the old concepts of having to be in the main street has sort of shifted. And all of this is leading to productivity and profitability increases.
So you mentioned earlier that things like annual fee agreements, are they considered a good thing from potential buyers? More engaged client?
Absolutely. And so any due diligence is really looking at the level of engagement, how much are active, how many are non-active. For many businesses, it's not really a challenge because they've been delivering annual services.
Yeah.
And so for some, it is a challenge, and that's where they've had to look at their service delivery.
Yeah, sure.
And
so what about as far as systems go? So internal systems, the old day where you had the filing cabinets out the back and, you used to go and pull it out and, sort of scrounge around before your meeting. What are buyers expecting to see now regarding systems for businesses that they're looking to acquire?
Well, in the due diligence process, all of the assessment is digital. So it used to be that, yes, people would come into the office, they'd pick up a file, have a look at the quality of advice, for instance. Now it's all digitally done. And so if you weren't before paperless, you are now. And most businesses, that hasn't been a significant challenge. Some have been moving with the technology. They've moved, sort of CRM systems because it's the one big weak spot as an industry that we've always had because the focus on due diligence is actually know the client. So the more data that you can have within the CRM, the better.
Right.
And so that goes to occupations now. Obviously, age is a key determinant to value. If you've got exposure of more than 30% to clients aged over 70, that's deemed to have a mortality risk within it. But it's now the quality of the information is a key determinant to whether your business receives a premium or a discount factor.
I suppose the more immediate impact as well, besides as a CRM tool, is it gets back to an operating efficiency. The better the data in the system, the more productive and efficient you should be in producing documents, reports, et cetera, et cetera. So I guess, that's another aspect of it as well.
Yeah, absolutely. But there's never been a greater selection or choice of tech out there as that we have right at this moment. There's digital SOA generations, there's outsourcing solutions which actually work irrespective of location, and high quality where you've got Australian educated accountants or financial planners that are located in Manila, for example. But you've also got Dropbox for security. So quality assurance is great, and we've always, this whole belief of having to work in the office and now having wider teams, domestically, but also now internationally. So outsourcing, I think, is really, with cloud-based technology, is really tipped over positively, and great cost savings, and particularly in times where you've got significant production concerns, and be that communication levels, be that plan preparation and distribution.
Yeah,
it's all there, and again, your back office efficiencies created by MDAs, IMA, SMA. One action across all portfolios simultaneously rather than doing 150.
I'm at day 5 years ago when I presented, I said 5 years ago everyone will be using an MDA. Well, to this day, I still can't see why everyone's not using an MDA. I just don't understand why.
Well, they're listening. It's happening.
Yeah. Okay. So what about in regards to businesses? I guess probably another aspect of the financial services industry per se that's always intrigued me is regarding sort of people offering financial planning services, accounting services, mortgage broking, blah blah blah. Is there any, are you seeing anything in regards to valuations, in regards to people that are actually doing a range of services well? Are people willing to pay more for that?
Yeah, they are. From a simple perspective is that you've got greater barriers around that client.
Yeah.
The other part is that with the more relationships that the client enjoys with the business, the less key person risk that you have.
Yes. It also gets back to engagement.
It does. And service delivery. Simplicity of multiple disciplines working on a single client, on a single decision simultaneously. So one example is accountant valuations. Normally on SMSF admin, immediately it's $1. It's not the 80-cent type of rule. And it's because there's multiple relationships and there's that revenue. The more you secure the client on the service, the harder it is for them to leave. But also, not only that, there's less reason for clients to leave as well. So yes, if you've got just a normal accounting business, that goes immediately sort of up to $1. Their EBIT rises from traditionally around 4 times, maybe up to 4.5. FPs at 6 times, mainly because of different profit profiles. Mortgage industry, if you've got a mortgage provider under the same roof, what's happening there is that you've got younger potential client base which is then shifting the FP client base, average age, which then, discount that I talked about before of over 70, all of a sudden you're coming back to maybe an average age of 50, 55, which is optimum. So yeah, it's self-supporting when it's multiple relationships. Now that the relationships don't have to be singly under the one roof. There's a lot of JV type of relationships as trusted advisors, where still the client is beneficiary of multiple disciplines. They're at the core of it. The financial planner is the GP saying, okay, go to this specialist. But when you've got that, it's a cohesive service delivery, which is highly valued.
Yeah, no, excellent. What about the size of the business? How does that affect valuation? So for example, if you've got a $500,000 business in revenue, you've got $1 million, or you've got a $10 million, how does the size of the business translate to any differences regarding what people are willing to pay?
Okay, so the irrespective of size, the multiple's likely to still be around that 6 times EBIT. But the larger the transaction, the more likelihood that the deal structure will be different. Seeing a lot more, particularly the sub million, you're pretty comfortable with a 12-month transaction. 1 to 3 million, you're looking at, or 1 to probably 5 million, you're probably looking at a 2-year transaction. But that's a really good business where there's a high level of confidence that the clients are still going to be there in that period of time. When you're 5 million plus, you're probably looking at closer to 3 years. And also, just to clarify, the smaller businesses may still be exposed to 2 years, depending upon the amount of risk revenue they have in there and how much of new business is being generated in the last 12 months. For many, that hasn't been a lot within the risk space. But if it is a component of it, if there's the expectation that there could actually be a risk to annual client engagement, if there's a perception of risk, that's when you'll start to go into more 2-year transactions, and 70% up front, 15% in year 1, 15% at the end of year 2, rather than the 70-30 that we've sort of traditionally known.
Yeah, okay. Anything else happening in the space that's of interest that people should be aware of?
Oh, look at, I think that there's a fair bit of stress that's been reduced with the removal of the, at least, phase-year acceptance of moving from January the 1st, 2021 to 22. Education degree qualification moving from 24 to 26. I think that's been a real release of pressure. The amount of stress that the industry's been under, let alone at a moment of crisis. I think that's been a great relief. And I suppose, whilst again we started off fairly dark as to where we potentially have been or are, I actually think that the future looks fantastic. I think there's going to be a restoration in trust with the banks exiting, and that was fairly significant trust level that was betrayed. So I think that we're going to see that. I think that also the greater corporate governance will be there. Greater education requirements will also increase consumer confidence. And at the same time, as we've talked about through this, is we're building better businesses with client outcomes being the start and the finish objective. We're seeing rising need for advice. And so I'm actually really positive about the future. We've still got some challenges. Obviously, the LIF review, asset review, is a significant challenge that we need to face. My hope is that rational decisions will be made, that we'll actually see our industry hopefully come together and fight for at least retention of what we have at the moment. There's plenty of international examples. There's chronic underinsurance at the moment. And again, I can't see any beneficiary to the consumer by changing it. So the hope is that our associations will get together. They'll fight like the mortgage industry did, and lobby effective. So that's still on our horizons. But again, I'm an optimist, but
you're a glass half full kind of guy, eh?
Yeah, I am, but I think that with politicians are starting to really look that they potentially have killed or trying to kill one of the core sectors of our community, namely financial advisors. Wide risk advisors need to complete the same level of education. Makes no sense. So there's still these inequalities, but we seem to be getting heard a lot more by the politicians now. And I think it's because of the way that we've dealt with this crisis and risen to it.
I think the other side of it is too, it's, the insurance companies, this hasn't worked out the way that they wanted it to work out either. So they've, all of this was, the thing that baffles me is all this was there for blind Freddie to see at the start. Everyone knew what was going to happen. It happened overseas. We all thought it was, it's going to be different here, and it never is. It's the same thing. And, insurance isn't getting written. Insurance is the classic Ponzi scheme. If you don't have new money coming in, it's lights out. So, all of this sort of stuff's the unintended consequence of these actions. Unfortunately, I don't think the politicians have got the strength to actually go, yep, we've stuffed this up and let's wind a bit of it back. I think they'll double down on a losing hand just from what I've seen. But in saying that, it is what it is, and you've got to play the ball on its own merits. And hopefully that's not the case. But in saying that, there's also opportunity that comes from that. And that's what I'm telling the young guys in the industry. Like, it's, just hang in there, get through this, because the pendulum's going to swing completely your way. Because there's still people trying to figure out how they pay for their house, how they save for retirement, how they make all their financial decisions. And until that stops, we've got a future.
Absolutely. And less people in there, more barriers to entry.
Correct. We've actually got a closed shop.
Yeah. So
we've got a closed shop.
It's actually affirming for valuations, and it's firming. And I also believe that we are taking quantum steps to professionalism. And acceptance of professionalism as well. And this is where I think it's that this breach of trust is now being, is this, and I think that the respect that's coming through from the wider community, and also I'd say from the political side as well. But
but then again, like when you break it down, most of that was as a result of the bad behaviour of the banks. And there was another article today, the banks have, ASIC aren't going to pursue the banks, and, it's sort of, I don't know, it just, to me, the fact that banks left has probably been the greatest change in the industry per se, and will lead to the most positive outcomes, putting aside lift reforms, fascia, all the other stuff put together. The fact that the banks are gone, I think that's probably going to be that's going to be far more significant benefit to the industry. Because they behaved poorly and there was no repercussions for it.
And we've seen the greatest level of disruption in our industry in the 30 plus years I've been doing it. And it's positive, because we're seeing what was, the 70% controlled by the big six is now flipping. So 70% will be independent.
Yeah.
And you won't just get this homogenized sausage factories, putting out a single product for all. It's actually going to be tailored advice and better advice. So that's one of the many reasons why I'm really positive about it, the future.
Well, let's hope that you're right, Steve. Let's hope that you're right. Because let's face it, after this coronavirus, mate, we're going to have the country saddled with a lot of debt. We've got a lot of issues. So it's, it's not going to be, the next 10, 20 years is not going to be a walk in the park. It's going to be a hard slog, and how we navigate these waters and come back from all of this stuff. There's going to be a lot of pressures on the tax base. How the politicians going to pay for this? People are paying more taxes. How can they afford to provide for themselves? How can they do their own thing? These are the things that we're going to be addressing over the next decade or so.
But also that underlines the need for advice.
Absolutely.
And they're saying advice is getting too expensive for Australians, and that's why we've only got about 20% of the population. But part of this re-engineering is there's a number of businesses that are coming out that are really quite low cost and high sort of touch, designed specifically for millennials or Gen X, Gen Y. The robo advice, we haven't really seen any successful examples to date, but robo and advice, is coming, and I think that many will import parts of that into their business for a certain part of their client base. So again, I think we've got technology solutions, and there is innovation within our marketplace.
Yeah, and innovation's got to be encouraged. And the thing that often worries me about conversations in our industry, it's about people saying that you've got to do it this way, you've got to do it that way. Well, innovation is all about offering the market different ways, and the market decides what they want.
Yeah,
it's not for people in ivory towers or on keyboards to decide what the world should be doing. Millions of people will make that decision far more collectively better than any of us individually.
Agreed. And it should be market-led.
Yep, absolutely. Let the market do it. But there is, and that's where I think at the moment where, regulation has gone too far. I understand where the regulation come from, and there definitely needed to be some changes, absolutely, but it can go too far. And hopefully, over the next little period of time, we can sort of get back to focusing on client outcomes as opposed to worrying about, whether we're going to lose our license and we haven't got a box ticked, which is a real concern for guys in the modern era.
Particularly those that are still within the big companies where their compliance is actually greater than legal requirements. Compliance is on top and not on tap. Every decision is made by via compliance. And that completely stops innovation.
And there's always a difference between compliance. Just because something's compliant doesn't mean it's any good, right? You can come up with stuff that's compliant, but it's not necessarily a great solution. There is a difference. Compliance doesn't necessarily translate into, good.
Well,
it's just compliant. That's all it is.
Well, that's why we've seen 55-page SOAs. Completely ridiculous. 5-page, can be done effectively as well. But you put a lawyer in the room, and that'll change.
Well, that's the way the world works. So it's hopefully you're right. I mean, hopefully things are. I think we just got to get through this next little bit. I think hopefully we've reached the peak of, the pain, and hopefully things will start to get a little bit easier because the transition has been quite long and quite arduous. There has been a lot of change, and people are suffering from fatigue.
And particularly, smaller businesses have been ones that have, in many cases, been bullied and harassed, and haven't had control levels. This is why the need to build profitable businesses above principal salary. Operate at 40% profit after you've paid yourself a commercial salary. That's when you've got a robust business.
So that's the figure, 40%?
Yeah, about 40%. 40% above what you pay yourself. Metropolitan, it's 150,000 salary. Regional, about 120. So 40% of profit above that. Now that's a big ask. We're moving from industry average is about 20%, and then moving to 40. But again, I'll restate, it can be done with the adoption of technology. It cannot be done if you do not change your business model.
No.
But the business model, by changing it, you're getting better client outcomes and better staff outcomes and better business, your family outcomes. So work from the stakeholders, from the client, but everyone wins. We're building better businesses, but you do need to change.
Yeah, and that's sometimes most of the time that's the hard part.
It is. What change evokes the first human condition is evokes fear.
And I guess that's a positive with all the reform and everything that's happened, is it actually forces you to change. So, it's sort of, taking a leaf out of your book and being a glass half full kind of guy.
A glass full.
So, mate, Steve, thanks very much for joining us today. Really appreciate your time, and I'm sure the guys will get a great deal from your insights. I no doubt we'll hopefully in the near future we'll be able to catch up at a conference the way we did in the old days, over a bar as opposed to over a keyboard. Yeah,
mate. Thanks for the opportunity. If there's any questions that come from this, please just come through to the website or my personal email, steve@forte, Forte, asset.com.au. Happy to answer any questions you may have.
No problem, Steve. We'll put your information up for the guys to access.
Brilliant.
Thanks, mate.
Thank you. Cheers. Thanks, Rob.